and the net profit. So net profit means after deducting everything, after deducting revenue, cost of sale, operating expense, depreciation, interest, and then you divide by revenue. So there you will get your net profit ratio. So in this example, we want to understand how depreciation will make a difference. So we assume here the company's age is 2 years, 5 years, 10 year and 0 year, because they don't have any fixed asset. They are just agent and they don't need any fixed asset, right? So how the net profit margin is different. If the company is new, they have a depreciation, higher depreciation, because we learned yesterday if you follow written down value method, right, you will have a higher depreciation in the earlier years but lower depreciation in the future years, correct? So the older the company, the lower it will be their depreciation. If you follow the straight line method, is different, it's okay. But if let's say they already depreciate everything, maybe it's a 15-year-old company, so the depreciation is 0, so their net profit margin will be higher, correct? Because they don't have a depreciation in their balance sheet, they don't have an asset in their balance sheet, but in actual terms they are using it, but it just is not appearing in the balance sheet or is not appearing in the profit and loss statement because it's already depreciated. Okay, so the net profit margin ratio is also, you can only compare, but before you compare you need to be careful. What are the depreciation policies? Yesterday we learned different depreciation policy, right? Straight line. What was the other one? Written down value, and there was the third one which is also normally used based on their usage, right? Production. So you can have 3 different methods of depreciation: written down value, usage and straight line, and also the age of the company. So all of this will affect your net profit because the depreciation charge will be different, correct? So you cannot just compare the net profit from one company to another company without looking at these conditions. And we are talking about interest here, right? We are deducting the interest. So what if one company is having loan free, for example Apple, versus compared to another company which has loans? So their gross profit ratio will be different, correct? So whenever you are comparing your company with another company to understand why our net profit margin is different from others, you need to understand what are the differences in their operations, how they manage the business. Okay? And then there are certain other ratios. For example, sales to revenue, expense control. How you are controlling the expenses. So cost of sales, selling and administrative expenses, distribution expenses compared to the revenue. So every year you can compare, okay, how much is my sales ratio to my revenue, and then you can see am I spending too much or too less. But if you look only at the number, it may be completely different. Higher volume you have, higher sale revenue maybe you need to pay. Okay, then you have research and development expenses. Will the research and development expense depend on sales or not? Or even the sale expenses will depend on revenue? Are you selling for today or past, or you are selling for future? When you make an advertisement today, you will get immediate revenue, or you will get revenue after 1 year, right? Or maybe after 6 months. So it doesn't mean that if you are spending a lot of money today in your sale is bad. It just depends on what is your future plan. Because normally you sell for future, right? You do marketing for future. You don't do marketing for past or for today. You always do it for future, correct? So most of the expenses, sales compared to revenue, will also give you nothing basically. What else? How you can use this to control your expenses then?